Hello, everyone. Thank you so much for joining us again. Today is Monday, June the 5th, and we are in our weekly mortgage and real estate review. If you're listening to us on our podcast, thanks so much for downloading our content. Remember to subscribe so you can listen to us weekly. If you're watching us live on Facebook, hello, Facebook world. And if you're watching this on YouTube, thanks so much. Hit that like, hit that subscribe button so you ensure you don't miss future content. Today, we have Kayla Frerot, Home Financing Advisor of ScotiaBank, here today to talk to us about what she believes the upcoming rate or Bank of Canada interest rate conversation is going to go like this upcoming Wednesday. Kayla, the floor is yours.
Good morning. Thank you for having me back. So we're just talking today about what we think is going to happen on June 7th, so Wednesday of this week, when Bank of Canada meets again to discuss the interest rates. So since March 2022, the rates have increased 8 times. There is a difference of opinion, but people are leaning towards seeing that we are going to have an increase in rates again when they meet, whether that be 0.25% or 0.5%. Remains to be seen. I do think that we are going to see a little bit of an increase this time when they meet, and probably one more increase before the end of year. Now, there are some people that are thinking that Bank of Canada will keep the interest rate the same. Right now, the Bank of Canada prime rate is 6.7%. So if they increase it, let's say by 0.5%, then what does that mean for people out there that have mortgages or even debt that's variable in a variable interest rate? So if you do have a variable rate mortgage, depending on which financial institution you're with, that could mean that your payment's going to go up if the interest rates go up. If it goes up by 0.5, you're looking at 7.2% as a Bank of Canada prime rate. So if your variable rate is, let's say, prime plus 0.5%, then that means you're going to be at 7.7%. So those people that are on the variable rate contract, that is going to see the payments increase. Just make sure that you're looking for that announcement on Wednesday, and how is that going to affect your monthly cash flow. There are some financial institutions that won't increase your payment when those interest rates go up or down. And when that happens, what that means is basically you're paying less towards your principal, more towards interest, which in the grand scheme of things, if your payments aren't going up every time those interest rates change, then you are going to see your amortization increase. So definitely worth touching base with your financial advisor or your home financing advisor when those interest rates increase or even decrease, just to see where that leaves you as far as your payments go. So that's kind of what we're expecting when they meet this Wednesday, is that there is going to be an increase, whether that be 0.25 or 0.5. That remains to be seen. And then it'll be interesting to see what happens after that. Now, inflation is a big driver when they meet and discuss those interest rate increases or decreases. Right now in the real estate market, we are seeing, it's a seller's market. We're seeing a lot less inventory than we had last year, with prices averaging around 360,000. And we are still seeing houses sell though, which is good. And yeah, that's kind of where our update is.
Yeah, I heard, it's interesting because I heard someone from the US talk about how it's a non-recession recession. So the average person probably isn't feeling it, other than the cost of goods going up, because interest rates are making groceries more expensive, gas more expensive, all of that sort of stuff. But job market is still strong. People are still earning income. They still have places to stay. So they're not getting impacted like a normal recession would. But interest rates continue to go up to really impact those who have assets. So a house, your investments, those type of things are the ones that are really getting impacted by the increase in interest rates. So it's a really interesting thing. The average consumer is not feeling that we're in a recession, but all indicators would say that we are, minus unemployment, which is still.
Well, yeah, our unemployment has increased just slightly, so not as much as we thought. So where you're going to see it is that when they're increasing the interest rates, you're going to see less people going out to buy consumer goods, right? So that's going to decrease that inflation.
Yeah, which we haven't seen yet, which is why it keeps going up.
Yeah.
And exactly. I also know there was a very smart guy who predicted a full 1% interest rate increase to start the year. I don't know
Was
who
that
it
you?
might be, but he might be tapping himself on the shoulders right now. But yes, so it's interesting to see. I think it'll be 0.5%. I know everyone out there is hoping it will be 0 to 0.25. So what we're going to talk about next week, though, is we're going to dissect what the actual interest rate means, how much it went up, and talk about how that actually is going to impact you now that we'll really know what the numbers are. So make sure you tune in next Monday, same time, same place. So if you're watching this on Facebook Live, thanks so much for joining us. Or if you're watching this on YouTube, again, hit that like and subscribe button so that you can make sure you don't miss next week's posting, because it is going to be a banger. And as well, of course, if you're downloading our podcast, Maxwell Devonshire Realty, and this one is weekly update for mortgage and real estate. Thank you so much, everyone. And thank you, Kayla. Have a great day.
Thank you.